Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. What I would like to do today is share with you 8 different companies that have a wide economic moat, all based in the United Kingdom. A lot of you have asked me recently to talk about UK based companies, so I found 8 different companies. All of them have a wide economic moat based in the United Kingdom, and that's what we're going to start with today, and we'll take it from there. Before we move on, as always, I would like you guys to join us on the Discord if you can, by joining us first of all on the Patreon account, where you get access to all of these things, including the Sharia compliant investing ebook, and then you get the Discord. The Discord is full of brothers and sisters who are actually very much like-minded. They are always discussing different types of stocks, things they're buying, things that are Sharia compliant, helping each other, and it's really like getting better, alhamdulillah. So I want to continue doing that. I want to help as much brothers and sisters out there, and that's the goal, inshallah. So I said 8 different companies that have wide economic moat, and that's the bit that I want to start with. I want to talk about what that means first. And as you can see here, this is the Morningstar definition of it. Okay, so it says the Morningstar economic moat rating can help investors uncover companies that will provide superior long-term returns. What we're after as investors is these returns. Okay, you want to buy companies that are going to be around for a long time and will give you a long-term returns. Okay, there are 5 areas that we look for. The 5 areas basically they look for when they decide if this company has a wide economic moat or not. And the first one is this, okay, intangible assets. They then look for switching costs, network effects, cost advantage, and efficient scale. What that means is this, okay? Switching costs is one of the probably easy one to get your head around. For example, ecosystems. A lot of companies like Microsoft, for example, they have their own platforms, their own software. It's not easy to move from one software to basically from Microsoft to Adobe, for example. It's not easy to move from basically AWS to another cloud system. It's not easy to move from Google to so it's even Apple has its own ecosystem. Once you buy Apple products, you in that environment, it's very difficult to switch. Okay, so that's one of the basically a lot of the software companies have actually switching costs. Okay, when it comes to economic moat side of it. Then we got intangible assets, and this is the brand recognition. McDonald's, Apple, Microsoft, they're very well-known brands. For that reason, anybody that enters those markets will not have the same brand names. For that reason, they have brand recognition, they have patents that going on, they have regulatory license and so on. So they have a lot of things going for them when it comes to the intangible assets. The next one is a network effect. This one is a hard one to explain, but the easiest way to explain in my head is, for example, if you have you have your own dating website, right? The more people that join your website, the more better it is for the customers. So each additional customer that basically joins it increases the products and services value, and that's one way to look at it. Okay, the cost advantage is another thing. So the cost advantage is this idea of you make a product for cheaper than your competitors and you sell it for the same price as they sell it for. For that reason, your margins will be a lot higher. Okay, and for this one here, it's simple. Okay, some companies do not want to enter that market because there's no reason, there's no incentives, for example, okay, to enter that market, because the markets are very small. Is very, they might not have enough customers in there. There's no reason for any other companies to join other than the 1 or 2 that's already in there. So that's the 5 things they look for when they decide if a company has a wide economic moat or not. So now you know that. We're just going to look at the 8 different companies. I'm going to go over quickly each of the companies in their details of, for example, the market cap, the moat, the price, and so on. So the valuation side of it, every single information that I share with you here comes from Morningstar for this section here, the Morningstar valuation, and everything else here, all the yellow section, all the way to the Simply Wall Street valuation comes from Simply Wall Street. Okay, right. First company that we're looking at basically today is Unilever. Unilever is one of the companies that I own in my portfolio. It has a market cap of $98 billion. It has a wide economic moat. Price right now is just below £40. Dividend yield of 3.7, payout ratio of 52%. And when it comes to dividend streak, we're looking about 10 plus years, and it's not stable according to this website. Profit margins 14%. They have about 6 billion euros right now of free cash flow. The earnings are expected to grow about 1%, and the revenue expected about 3%. Simply Wall Street is saying is about 11% undervalued at the moment, and £43 is basically where they think the price should be. Morningstar is basically saying it's 15% discounted right now. 57% is where they $57 per share is where they think the price should be. The next one is AstraZeneca, another huge company, 170 billion market cap, has a wide economic moat. Prices right now £109. Dividend yield at just above 2%. Payout ratio 73%. Now this 73%, sometimes depending on the website you're looking at, some websites are saying is way lower than that. So I'm going to stick with whatever I got from Simply Wall Street. Okay, so dividend year streak, basically they have increased that dividend 10 plus years. Dividend is stable right now. Profit margin 14%. $12 billion of free cash flow right now. Forecasted to grow up earnings about 18%, and then revenue is expected to grow about 7%. They're saying about 37% right now undervalued. £189 per share is where they think the price should be. 14% discounted according to Morningstar. Fair value of $78 per share. This is one of the companies that I've been buying heavily, and I will continue doing that because of what's in front of you right now. The next thing is our next company is RB. This is another company that I own. 41 billion market cap. Wide economic moat. Prices right now £57. Dividend yield of 3.3%, which is really huge. Payout ratio 60%. Dividend streak of 10 plus years. It's stable. Profit margin 15%. £12 billion of free cash flow right now. Expected the earnings to grow about 7%. And then revenue is expected to grow about 3%. Simply Wall Street saying 20% discounted right now. £71 is where they think the price should be. Discounted about 10%. $77 per share is where they think the price should be, according to Morningstar as well. Another company that I'm buying as well, according to basically based on the information that's also in front of you. The next company is Halma, is 7.5 billion market cap right now. It has wide economic moat. About £20 per share right now. Dividend yield of just 1%. Payout ratio 33%. They have increased their dividend of 10 plus years. Not stable at the moment. Profit margin 13%. £212 million of free cash flow right now. 7 billion market cap, so that's not bad at all. Forecasted to grow their earnings about 8.5%. Revenue growth of 5.5%. Simply Wall Street is actually saying about 20% right now overvalued. Their price is about £16 right now. Morningstar saying 14% discounted. $28 is where they think the price should be. Next one is Experian website, company or stock, whatever you want to call it. And 25 billion market cap right now. That's in pounds. It has wide economic moat. £27 right now in terms of price. Dividend yield of 1.6. Payout ratio 65%. 10 years of increase in that dividend. Dividend is stable right now. 12% in terms of profit margin. $1 billion of free cash flow right now. So a company that has $25.4 billion and to have $1 billion, that's actually good. Forecasted to grow their earnings about 15%. Revenue right now we're looking about 7%. They expected to grow about 7%. Simply Wall Street saying about 2.6% overvalued. Fairly valued value of almost £27 is where they think the price should be. So it is around that right now. Morningstar saying about 9% discounted right now. Their price is $37 per share. The next one is Relics. I've spoken about this company a while back. 53.9 billion market cap, wide economic moat, £28 price wise right now. Dividend yield of 2%, 61% payout ratio, dividend streak of 10 plus years. They expected the stable in terms of dividend yield. Profit margin 19%, free cash flow $2.55 billion pounds, which is quite good. 9% in terms of the forecast. In terms of revenue, about 5%. Simply Wall Street saying about 17% overvalued at the moment. $25 per share, £25 pounds per share is where they think the price should be. Morningstar saying 7% premium right now. $32 per share is where they think the price should be. Next one is Rightmove. This is the company that I used to when I was buying my property. I used basically to find the property, and there's another one called Zoopla, and between the two of them I don't think there's other websites better than them out there. For that reason, they've given them a wide economic moat. 4.7 billion market cap, still a small company. Price right now is $5.78, dividend yield of 1.5, payout ratio 37%, dividend streak of 10 plus years. Not stable at the moment. Profit margin 56%, which is absolutely huge. Almost 200 million pounds of free cash flow right now. Forecasted earnings to grow about 5%, revenue to grow about 8%. Simply Wall Street is saying right now overvalued about 15%. £5 is where they think the price should be. Morningstar is 4% premium. $6.72 is where they think the price should be. The last one is Barrack Sarco, is one of the companies I'm looking at right now. I might add it to my watch list. I will give you more details, inshallah, when that happens. But right now it has a 7 billion market cap. It has wide economic moat, $94 per share, 1% of dividend yield. Payout ratio, we're looking at about 54%. Dividend streak of 10 years. Stable right now, 12% profit margin right now. Free cash flow 244 million, which is absolutely huge in comparison to where they are now in terms of market cap. 12% growth expected in terms of the earnings side of it. 6% in terms of revenue, overvalued about 18%. £80 per share is where the price should be according to Simply Wall Street, and Morningstar is saying 16% discounted. $131 per share is where they think the price should be. These two companies, of course, they have different analysts looking at different things. For that reason, they're not going to agree with everything. In terms of Sharia compliance side of it, absolutely no issues. The one that has the highest in terms of different interest-bearing debt is Unilever. The rest of them are absolutely fine. So there you have it. 8 different companies have wide economic moat, all Sharia compliant. Some which are discounted according to Morningstar, some which are discounted according to Simply Wall Street. But you're going to have to, of course, go away, do your research, find out a bit more information about the companies and so on. And as always, if you like this type of content, give the video a like, because it genuinely helps a lot, okay? And join us here. Again, something that really helps, and it will definitely help you, inshallah, if you join us on the Discord. There's a lot of brothers and sisters out there that are discussing some amazing things, inshallah. And as always, I will let you know if anything comes up. And right now, there's a lot of noise going around the market. I wouldn't worry too much about it. I've added my £250 for this week. I'm going to invest that, inshallah, in the next couple of days. I'll let you know what I buy if going forward. And as always, you know, it goes up, the markets will go up, it will go down, but the most important thing is buy quality companies, hold them for a long term, and forget about the rest, inshallah. Have a wonderful day. Assalamu Alaikum.